Welcome to QAV US edition, episode 001, license to kill the market. My name is Cameron Reilly. With me in Victoria is my co-host, Tony Kynaston, aka TK. How are you, TK?
Very well, thanks, Cam. Am I supposed to speak in another dialect? Hi, y'all.
We'll do some American accents.
Uh,
We'll phase in and out. So for people who are listening to this for the first time, welcome. If you're an Australian listener, you probably know us from our Australian show. For American listeners who haven't listened to the Australian show, just a quick background. So Tony and I have been doing this investing show for 5 or 6 years in Australia. Basically, we teach a method of value investing that Tony has developed over the last 30 odd years that we call QAV, which stands for quality at value, basically identifying quality stocks and buying them when we can get them at the right value or a discount to their intrinsic valuation. Tony, over many decades, developed this system for himself, and we've been teaching it on a podcast, as I said, for 5 or 6 years, focusing on the Australian market because that's where we both live. But over the last couple of years, we've had listeners in the United States say to us, hey, we'd really like to have you talk about the American market so we can apply it to that. And so about a year ago, I did develop a version of our checklist for the American market. I built a test portfolio, and it's done reasonably well compared to the S&P 500 over the last year and a half. And so we thought it was probably time to start a US version of the show. Now, if you want to know the details about Tony's background or the QAV system or the checklist, we're not going to cover that today because we have a couple of dedicated episodes that goes over that in great detail. If you go into our archives, find episode 301, 303, and 305, you can hear us talk about those things for a few hours and get a good sense of how it all works. What we tend to do in our weekly shows is we talk about the portfolio, any big movements in the portfolio. We talk about what's going on in the markets, any big news stories, either involving the market in general or the stocks that we have an interest in the market, get a sense for what's going on out there. And I think that's where we're going to start. And quite honestly, because we haven't really played a great deal in the US market, even though Tony lived in Toronto for, about 5 years, Tony?
5 years, yep.
And that was, about 10 years ago? How long
No,
have
I've
you been
been
back
back
here?
6 years.
Oh, right. But even when you were over there, you didn't really invest in the North American markets, right? You just stayed invested in Australia.
Yeah, that's right.
But Tony, you developed this system by studying classic value investors, many of whom are or were Americans, guys like Buffett, Charlie Munger, Peter Lynch, etc., and then sort of taking bits and pieces of their methodologies, their teachings, and building your own system around that. And of course, the theory behind value investing should be applicable regardless of the market you're in. Basically, we're trying to find well-run businesses that are generating a lot of cash, have got a good track record of being well-run, but for whatever reason, they're undervalued by the market at the given point in time. We try and identify them at that point in time. We buy them and then wait until the market realizes that they're undervalued and the share price goes up and it's happy days.
Yeah, no, that's value investing in a nutshell. It's adapted a little bit from, pure Buffett and Munger, largely I think because I didn't have the time or the aptitude to drill into financial statements in the way they do. And all their business experience. I've run a couple of companies in my corporate career, worked for some big companies, so I have a pretty good knowledge of finances and business. But I guess my circle of competence was in retail, and we invest in all sorts of other different companies, and that led me to developing something based on the numbers that I could quickly scan the market for companies that met, it scored well on a checklist, and then go from there for my investment portfolio.
Yeah, and for me, coming into this, not knowing much about investing 5 or 6 years ago, one of the things that I've really appreciated about QAV as I've built my own portfolios over the time that we've been doing this is that I don't need to become an expert on any particular business or sector. I just had to become good at being able to read the numbers, understanding the numbers, letting the system tell me what to buy, when to buy it, what to sell, when to sell it, and making the decisions for me because the decisions are based wholly on numbers and charting, really. It
Yeah, numbers and
removes
rules.
numbers and rules. Yeah, it removes the emotion
Mhm.
from the process. And as we've talked about many times over the years on the show, emotions are probably what mess up many investors, particularly novice amateur investors. They either get caught up in the hype cycle and buy things that they shouldn't be buying because they get swept up in the fear of missing out or the hype about what's going on. And conversely, they will then sell when there's a lot of negativity in the marketplace, and they might sell at times when they shouldn't be selling because they're not selling for the right reasons. So they buy for the wrong reasons, they sell for the wrong reasons.
Mhm.
And one of the great things about having a system, a checklist that tells you what to do and when to do it, is you sort of avoid the emotional mistakes that novice investors tend to make.
Yeah, if I could just
So,
add to that too, I think it also people should realise that following that checklist doesn't mean we avoid every mistake. There's a statistical element to this that it improves our chances of making good decisions.
yes.
Certainly, I've fallen into the camp as you've described of buying at the wrong time and selling at the wrong time. I think it happens to every investor, but having a framework to do it improves our odds of getting, 6 out of 10 right, as Warren Buffett says he gets.
Yeah. And I think that's a great principle is you only need to get 6 out of 10 right over a long enough period of
Mm.
time to make a big difference. And the other thing that people should understand if they're new to QAV is we're not trying to shoot the lights out. This isn't a short term, get rich quick investing strategy. It's the opposite of that. It's about
Mm.
having a set of core principles that you follow over the long haul
Mm.
that will give you good, on average, good returns versus the market. We aim for double market over a long term, not trying to do 100 times the market or 1,000 times the market in 6 weeks or your money back. It's a set of principles that we follow day in, day out, week in, week out, year in, year out. Doesn't
Mm.
matter where the economy's at, where the cycle's at, if it's a boom, if it's a bust, doesn't matter what's going on. In fact, it's kind of boring because we're always just follow the rules, get up in the morning, follow the rules, and it will keep you relatively safe.
Keep you
So,
safe. Ideally, not be uh, too much of a drain on your time. That was one of the things that I was always careful to try and engineer into it. I still, read the financial press every day, but I oftentimes won't look at my portfolio for weeks on end. I set some alerts and based on our rules and wait for those to be triggered. And then maybe after, it's 6 monthly reports in Australia, quarterly reports in the US, I might go in and update my rules or um, have to do something because that's generally when the portfolio has its biggest moves is when new numbers are announced.
and as a result of the value investing system, the way that it's constructed, we tend not to be involved in high risk, high reward stocks. We're not buying crypto. We're not buying the Mag 7. We're not buying anything that could drop suddenly, usually. There can be results come out and a stock can take a hit, but generally speaking, we're not buying high flying companies that are running on massive PEs and massive future promises. One of your favorite sayings is, if I wanted to hear a story, I'd buy a book. We don't listen to CEOs' stories. We don't listen to analysts' stories. We don't read, we don't care about the stories about pumping companies or sectors up in the financial press. It's show me the numbers and we'll make decisions based on the numbers. Speaking of the numbers, I mentioned the US portfolio. So I'll post this on our website on a regular basis. So I track it via the Stockopedia service where we get our numbers from for the US market. I started our US portfolio almost 2 years ago now. It was in March of 20. Hold on, no, it goes back even longer than that. September 2023 it was, not 2 years, a year and a half. And over that period of time, it's grown about 83% versus the S&P 500, which is up about 34% over that period of time. So not quite triple the S&P 500, but not far off triple. Now, that's pretty good from where we sit. I wouldn't expect it to do that long term. I think double is probably a more realistic expectation long term. It obviously doesn't compare with some of the growth that the Mag 7 stocks have had in the last couple of years. But again, we're not trying to compete with the Mag 7s. We're just trying to get good returns. The way I normally talk about it, it's relatively low effort, relatively low risk, relatively conservative, and trying to get pretty good returns for those things. Not trying to get the best returns in the marketplace, but just pretty good returns. Double market's pretty good with relatively low risk in a relatively low time and anxiety level mix.
Yeah, I mean, just to add to that, from my experience, look, it can be hard being a value investor when stocks are going up in the growth sector. But it's great being a value investor when they come down. So we just gone through the Australian reporting season, and some of the stocks I have dropped 10, 15% on supposedly bad numbers, and they've recovered quickly. But I know from experience, if it was a growth company on a PE of 70 or 80 times and they delivered a similar bad number, they don't drop 10, 15%. They drop 30, 40, 50%. So it's when the PE is lower, there's less compression that can occur with a bad miss or with a miss. So that's, I think that's important to remember. We give up. Well, I don't think we give up any of the upside. I think over the long term, value and growth traditionally have, depending on the cycles, been reasonably similar in long-term returns. It's just that one's more volatile than the other, really.
Yeah, and gets more headlines than the other.
And gets more headlines, yeah.
Yeah, and I often talk when I'm talking to people outside of the podcast, just at parties, which I'm never really a big hit at, but I will, because I'm either talking about ancient history or the Cold War or investing. I talk about the difference that I've learned from you over the years of doing this between being an investor and being a speculator or a gambler. Like a lot of these high PE stocks have a high PE because people are speculating on what their future returns will be based on the future of artificial intelligence or the future of .coms or the future of daffodils or whatever it is that the bubble is in at the time. And some of those speculations will pay off. Many won't. Historically, we can go back and read about how these speculative bubbles play out. There usually are a couple of companies that do quite well and survive somehow during the consolidation and collapse phase. But being able to pick ahead of time which ones are going to survive and which ones aren't is inordinately difficult. Even the people that specialize in these sectors, like venture capitalists who do it for a living, tend not to have a great track record of being able to pick the winners and losers, which is why they invest in 1,000 of them and hope that one out of those does well and they can
That's
write
why
off the other 999.
that's why they use other people's money to do it too. They
Yes.
clip the ticket. Yeah.
Yeah. And the companies that we tend to invest in tend to be companies, again, that are relatively boring. They've been around a long time. They generate cash rather steadily. They're pretty well run. And for whatever reason, their share price isn't really being appreciated at the moment in the marketplace. We try and pick them up when they're cheap. You said on a very early one of our shows, buy stocks the same way you'd buy anything else when it's on sale.
Correct. Yeah. And sometimes the companies we invest in are cheap because of the fact that people don't see them as being sexy and high growth and all that kind of stuff, but they still chug along. And we use the coffee shop examples. Everyone can relate to their local coffee shop, and it's not too hard to know if that business is doing well or not, and not too hard to understand, if you were offered the chance to buy it, whether it's a good price or whether it's a bad price. And generally, if the owner's selling you the business and they're telling you about all the wonderful plans they have for the future, but the place is empty, it's a bad price. And that's the same sort of conversations I have at parties when I talk to people about investing and they tell me how great their portfolio is going. I just ask them some questions. Under what circumstance are you a seller? And usually it's, to the boom, I'm not going to sell. Like, it's okay. Well, that's the first thing you've got to work out, because no tree grows to the sky and eventually you're going to have to sell. You got to work out at what circumstances, because those high-flying companies can drop all the way back down to pretty much where they started from, which was my experience in the .com bubble when it burst, and the GFC when I was investing. But those companies dropped very, very heavily. Up the stairs and down the elevator shaft is the saying for companies like that. So the first question is, when do you sell? And the second question is, where's your crystal ball? Because if you're basing your whole investment thesis on what the company's going to do, it's good luck to you, because it's all prediction. And I ask people what the odds are of their prediction coming true, and they've got no idea. So then the question is, well, how do you know how much money to put into it if you don't know what the odds of the prediction coming true are? And we saw that with all of the buy now, pay later companies, which was probably one of the examples of our latest booms in Australia. And it did go into the US as well, where people with stars in their eyes were talking about, it used to be called eyeballs in the .com boom, but now it was called the addressable market these days. How many people out there with credit cards that were going to cut up their credit card and replace it with 4 equal payments on basically an electronic lay-by system, and how big that market was. And all those numbers were right. What was wrong was the prediction that the buy now, pay later companies were going to take it over. They've had great penetration, but they haven't had complete saturation, as most of the predictions were saying. And so, like if you're basing something on the story of what's going to happen, you got to treat it like any other story. It's a work of fiction. Hopefully it has a happy ending, but you won't know until you get to the back page. And that can be costly going on that journey.
Well, speaking of why and when you're going to sell, we have a couple of what we call sell triggers in QAV, and one of the main ones is what we call the 3-point trend line sell, where we do some charting and we look at where we think the sentiment of a particular stock is heading based on drawing some 3-point trend lines. And I had to sell 2 stocks out of our US portfolio yesterday because they had both breached their 3-point trend line for a sell trigger. One of those was Land's End LE, which we had held for a little over a year. I bought it November 2023 at $6.92. Had to sell it yesterday at $11.78. So we got out of that with a 70% return over, 14 months, give or take, which was quite good. Land's End, interesting company. People in America would be familiar with Land's End, I'm sure. Very big retailer, been around for a long time. But the 3-point trend line sort of tracks where the sort of low points are in their share price over 5 year, when we look at the end of month prices over 5 years. And it gave me a sell trigger for it yesterday, so I decided to let it go. And again, that's sort of a no-brainer for us because I don't need to drill too deeply into their financials. I don't need to think about the retail sector or the impact of interest rates or the impact of tariffs, or I don't have to calculate any of that kind of stuff. It just tells me that I should sell it. And so I did sell it, for rightly or for wrongly. We'll probably never know, but because we'll move on and buy something
We
else,
don't
which
look
we
back.
did.
Yeah.
Yeah. It's the ex-girlfriend rule. Never look up your
Yeah.
ex-girlfriends and see what they're doing now.
Yeah.
The other company I had to sell yesterday was GSL, Global Ship Lease, which is a United Kingdom-based container ship owner. We'd held that for a shorter period of time. I think I bought that in January of 2024 at $20.52, sold it at $21.83. So it was only a 6% return for us over a year, which is not going to make anyone's day, but we got out of it positively. So I'm not complaining, but I should point out for people that are wondering why our portfolio has done so well over the last 18 months, I'll just read out the list of stocks and what the returns are in case people are skeptical. The biggest hitter for us has been a company called Willis Lease Finance Company, WLFC. It is what it sounds like. It's a finance corporation, a lessor and servicer of commercial aircraft and aircraft engines. It's up 326% since we bought it. Let me see. When did we buy it? November 2023 at $47.34. And today it's trading at $201.48. So it's really been a great holding for us. Some of the other stocks that we hold that have done well, BLX, the Foreign Trade Bank of Latin America, it's up 69% since we bought it. ENVA, Enova International, is up 67%. RM, Regional Management's up 38%. OPHC, Optimum Bank Holdings, is up 28%. And then we've got a handful of others. ESEA up 20, CPSS up 13, KT up 11, UBS up 11. So, they're not all gangbusters, but there's a handful there that have done very well for us over the last 18 months, and that's really helped our returns. I mean, you don't get a stock like Willis Lease Finance come along very often that does 300% over 18 months, but nice to have when you get them.
No, exactly.
And what in my short period of doing QAV and looking at your results over the last 30 years, the way it tends to work, I think, is we tend to have a really, really good year where we get really outsized returns. And then we'll have a couple of really bad years or very, very average years where we underperform the market. And then a bunch of years in the middle where we'll do sort of market level returns, a bit better, bit worse, but they sort of are somewhere neutralized in the middle there. And over a long period, I'm talking 5, 10, 15, 20 years, it sort of balances out to where you end up doing about double market over the long haul.
Yeah, that's a fair assumption, and you can see that in the Australian dummy portfolio that we set up when we started doing the podcast here 5 or 6 years ago. It outperformed incredibly when we first started before COVID hit, and then we got out of the market as COVID was breaking, and then got back in on the way up. So we locked in our outperformance, and then probably in the last couple of years, last 3 or 4 even maybe, we've kind of just gone along above market, but not as strongly as it was at the start. And that's
Yeah.
that's pretty much, that's a good template, I think, for how outperformance normally occurs longer term.
We did really well during that COVID period, late
Mm.
2020, early 2021, because again, I think largely because our system told us to start investing. We like to
Mm.
stay fully invested when the system allows us to be. And we did that pretty quickly when the impact of COVID in the Australian economy wasn't as dire as early predictions thought it might be, when the government came in with a rescue package pretty quickly. And we got all of the growth that came off the bottom after the market plummeted early on in COVID, really outperformed, and then locked in that outperformance and have kind of just gone back to being basically double market over the last 5 or 6 years in Australia. So that's a quick, rough summary. And by the way, I sold those two and I added one stock, which was Zim Integrated Shipping Services, which I think you're going to talk a little bit about. We
I
like to
will.
do a segment every episode that we call a pulled pork for some reason. I'm not sure why we started calling it that, but Tony was going to do a deep dive, pulling it apart.
Mm.
My
A pull
wife, who's an
apart.
American who comes from Utah and loves pulled pork and makes pulled pork on a regular basis, I think I said we're going to pull it apart like a pulled pork, and then it became the pulled pork segment. By the way, when you said a coffee shop analogy before, I was like, Chrissy's family in Utah don't understand the coffee shop analogy because Mormons don't drink coffee. So
Ah, okay.
if you're in Utah, think of it as a soda shop
Right.
analogy, maybe. Yeah. Or
Just a corner store
shave,
nearby. A very simple
the sh-
business to
a
value.
shaved ice shop
Right.
nearby. Uh, Shout out to all the nice folks in Utah. So before we get into Zim, Tony, I was looking through news stories for what we could talk about in the US market. People may be wondering, what do two Australians know about the US market? The answer is nothing really.
Mm.
You know, we're coming into it with fresh eyes. I mean, we read the news, we pay attention, but we're definitely not experts on it. But I think one of the things QAV has demonstrated to me over the last 5 or 6 years, you don't need to be an expert on anything, really, if you understand how to read the numbers and follow a system, which is good.
I think it's
But
important to say that a lot of our Australian listeners use us as a starting basis to develop their own investment style or system, following, I guess, the framework of QAV and using some of our tools and our buy list and our sentiment checker and things like that, but doing their own thing, which is entirely what we're trying to do. It's to educate
yes,
people. We don't get anything out of whether you buy or sell a share. So it's not about that. It's about, here's what I've done, and Cameron and I talked about it, and I started to teach him, and then we put a podcast together, and then people got interested, and it's kind of a giving back for me on what I've learned over the years. But yeah, I mean, we're not trying to push a system for slavishly following. It's a framework. We like it when people modify it and come back and tell us what they've done and how it's worked or it hasn't or whatever. So yeah, it's more of a hive mind, I think, with what we've been doing in Australia over the last 5 or 6 years, which has been great.
and it's evolved over that period of
Mm.
time as well. You know, you've modified things,
Mm.
added things, changed things as we get feedback, and we're doing continual regression testing and using AI to test things more and more, and sort of looking at ways that we can optimize it, tighten it up, improve it. So the only news story that I really had to talk about today, Tony, I got in the New York Times yesterday. Stocks dropped in February as economic concerns crept in. I just grabbed a couple of paragraphs out of this. Stocks had climbed in the aftermath of President Trump's election win as traders geared up for lighter regulation and tax cuts, anticipating that they would add up to accelerating growth. But that rally has stalled more recently as anxiety about the inflationary impact of new tariffs began to grow. A slump in technology stocks this week also weighed on the broad market. The pullback was driven in part by renewed concerns about the inflationary effects of sweeping tariffs, which Mr. Trump has already imposed on China and has said he will broaden to Canada and Mexico next week. As recently as late 2024, investors had expected the Federal Reserve to cut interest rates several times this year, moves that would be positive for stocks and the economy, but that view has shifted quickly amid concerns that inflation will linger longer than expected. With rates set to remain elevated, worries have extended to the broader impact on the economy. Recent economic surveys showed a sharp decline in consumer sentiment, in part because of pessimism about employment prospects, as well as expectations that prices could start to climb again, have fueled caution among investors too. Now, some investors, when they read stories like this and read indications about the future of the economy, may be worried about whether or not they should be investing or how they should invest. But I know from experience that when you read stories like this, you just go, and so what?
Yeah,
And
I don't read them.
and
Yeah.
explain why, Tony.
Well, stories like this can drive the market, but is reporting what happened in the market, and there's some legitimacy to that. If I was somebody who knew an awful lot about the automobile industry, I might be concerned about the effect of tariffs on Canada or Mexico, which is what the market got the wobbles for last night as we were recording on the 4th of March in Australia. But I don't know enough about the automotive industry to predict what's going to happen because of tariffs. I'll wait and see whether automobile manufacturers come onto our buy list now because they've been beaten up by the market's perception of tariffs, even though they're probably still very good underlying businesses. But we'll make an assessment on that. So, yeah, it's more about dealing in the facts and dealing in the speculation that I worry about. I do read the financial press. I think it's still important to know what's going on. But really what I get interested in the financial press is if there's a story about one of the companies I own and maybe about their results that they've just released or something like that. That's what I'll pay attention to, not necessarily the big macro picture of what's going on.
Macroeconomic forecasts doesn't really matter because at the end of the day, we're buying based on the numbers. Numbers are the numbers. In good times and bad times, there's always something to buy, and there's always businesses, at least in my experience so far, there's been very rare periods where there hasn't been anything to buy. There may be a week or two where I struggle to find stuff to buy, but generally speaking, there's always something to buy. And there are businesses that do well in certain parts of the economic cycle. There are other businesses that do well in other parts of the economic cycle. We're just trying to find those and buy the ones that we think are undervalued today based on their numbers, right?
Yeah, and it's often the case in terms of macro cycles. I don't really see what the macro cycle is industry by industry until I turn around after 6 months and say, I've got a few banks in my portfolio, or I've got a few airlines in my portfolio, or whatever. And you realize that that's because that industry was bombed out and we bought the companies that were in it because they've been around for a long time and they're still good quality. And then, of course, they started to regress to the mean again. And whatever headwinds they were facing eventually blew out, and then they came good again.
Yeah. All right. Well, that's all that I wanted to cover off on today, just as an example of how we think about macroeconomic forecasts. Do you want to do a bit of a pull pork on Zim?
I will. Yeah. So this is a new one in your dummy portfolio. I guess I want to say before we get into it that we very rarely focus on the story or any sort of filtering over the particular company, and we've covered and analysed and bought and sold coal companies and oil companies, and everyone's got their own filter or their own red line, as I like to say, on companies that they don't want to buy. And that's completely up to the individual listener and investor. And so I'll say that at the start, we'll still cover these companies, and you can make it your decision as to whether it's on your list or off your list. But the numbers for this company are on the list. And the reason why I've given that preamble to this company is because it's based in Israel, and that I'm not going to have a perspective at all on the Middle East. All I'm going to do is talk about the numbers for this particular company. And if it is of interest to the listeners, they can go and do their own research and then decide whether or not they want to get involved or look on. This company, Zim, is a global shipping company. It is based on the New York Stock Exchange, even though it's from Israel. It's been around 75 plus years from when Israel was founded after World War II. And in fact, the first boat that was bought by the company was to bring people from post-war Europe to the Middle East. So it's tracked the history of Israel all the way through its history. 1953, they started to expand more internationally, and they acquired 36 passenger, cargo, bulk carrier and container ships. They launched a range of passenger and cargo services. They continued to do that, but discontinued the passenger service in the late 1960s as air travel became more popular and more widely accessible. So they moved at that stage completely into international cargo shipping, and they've been doing that ever since. By the time their 25th anniversary came around in 1970, the company owned 77 ships, chartered 70 ships, and operated 19 major cargo lines carrying 4.3 million tonnes of cargo annually. After that, they were a pioneer in the area of containerized shipping, which is now one of the first carriers in the world to adopt the technology that was new at the time. I've got to say, I think containerized shipping is one of the unsung heroes of the 20th century in terms of the impact it's had on our lives and our economics that probably people overlook every day. But just the mere fact that cargo used to be shipped piece by piece, pallet by pallet, bag by bag, and then unloaded and repackaged and put on a truck or a train, and then unloaded and repackaged and reassembled in warehouses, and then taken by small trucks to local shops and then taken home by you in your car, to move to the fact that everything is now moved in a standardized container that can be picked off a ship by a crane, dropped onto a flatbed rail truck, shipped around internally in a country, taken off the train at a siding, put on the back of a semi-trailer, without ever having to have the container opened and repackaged is just amazing. And it's just, allowed for productivity increases worldwide and probably driven the whole backbone of international commerce for the last sort of 50 years. So Zim have been in the middle of that and were a pioneer for that. In 2004, they became a private company. So they had been partly owned by the Israeli government up until then. And then in 2021, they IPO'd on the New York Stock Exchange. So quite a long history, now fully publicly owned. If I look at their latest results, which is the Q3 results, so from end of September 2024, total revenues for the 9 months of the year were 6.2 billion compared to 3.9 billion the year before, so a significant increase in revenue. The company called out that was driven both by increases in freight rates as well as by carried volume. They carried 2,768,000 TEUs, they're called, which is their terminology for 20-foot equivalent units. Again, these containers that we're talking about. They carried 2,768,000 TEUs in the first 9 months of 2024, compared to 2,496 in the first 9 months of 2023. The average freight rate for that per TEU was 1,889 for the first 9 months in 24, compared to 1,235 for the first 9 months of 23. So numbers are up across the board for this company. They declared a special dividend on top of their regular dividend. So a special dividend because they did have a very good quarter. So all in all, good results. If I run through what we call the QAV numbers now, this is I'm going to go through our checklist and look at the scoring this company based on the things that we find useful. All these numbers are in US dollars, by the way, if anyone from Australia is listening in or anywhere else in the world. Zim has just become a buy on the sentiment checker, but it's currently what we call a Josephine. So a couple of concepts to explain there, and I haven't used the term yet, Brettolator, but it's what we call our sentiment checker because it was coded by one of our listeners called Brett, so we call it the Brettolator. Basically, I'm not a fan of charting. I've tried to use it in the past and never found it to be a useful tool in and of itself. But what I did find was that, as like a lot of value investors, I was a buy and hold investor until the GFC came along, and I watched my portfolio dwindle by a lot in the GFC, and I thought there has to be a better way of doing investing than to see that happen and have that kind of hit to your portfolio. And I guess came up with did some reading. There's a lot of research out there about moving trend lines, and people might be familiar with that if they're listening in, about 30-day averages over 90-day averages and things like that. And this is what we use as kind of a refinement of that. Very simple concept. I use a 5-year monthly graph. So it's really a high level trend line. It doesn't move around as much as a weekly or a daily or a yearly graph does. So we take a bit of volatility out of the graphing. And if you look at any stock on that kind of period, you'll probably find that it moves in a channel up and down. So they still wiggle around and zigzag, but if it's doing well, it goes from the bottom left to the top right, and if it's doing poorly, it goes from the top left to the bottom right. It may go up and down in that process, but generally it follows a channel. And you can draw a line across the bottom of those troughs and across the peaks of those highs, and they become the breakout indicators. And so we've coded that process. Zim recently went through its buy, so it reversed the downward trend according to that sort of 5-year monthly graph. But it's currently what we call a Josephine, as in not tonight Josephine. So even though it's broken out of its long-term downtrend, it's got a short-term downtrend, largely I think due to the market sell-off in the last day or so. But it's one to watch, and when it rises again in the short term, it might be of interest to people. So we're looking at both the long-term trend for sentiment and the short-term trend for sentiment. When we started talking about this, it was a buy on both of those. It's currently a buy on long-term and a wait on the short-term. But anyway, that may change before people listen to this. One of the other terms I want to explain, one of the key performance indicators in our checklist is a thing we call PROPCAF, or price to operating cash flow. And that's the heavy mover on our checklist. The price to operating cash flow for this company is 0.88 times. In other words, if you think about PE ratios, this is similar in concept, but we're talking about the operating cash flow that's been thrown off by this company. So we can buy this company at a share price which is less than the cash it makes in a year, which is a very cheap metric for value, a good indicator of value in the company. We generally like companies that we can buy for less than 7 times operating cash flow. So this is way under that threshold and puts it very high up on our buy list of stocks to have a look at. Now, a couple of concepts to explain there. Why operating cash flow? A lot of analysts will focus on free cash flow, and I've got no problem if you're skilled enough and detailed enough to wade through the financial statements to get there. I started off as an investor 25, 30 years ago looking at PE ratios. And one of the things I learnt from my experience was that the earnings of a company can be manipulated by the executives of the company. Not necessarily for nefarious reasons, but they are always having to make calls on how much to provide for things, like capital in the future, how much to amortize equipment, how much to depreciate office furniture, how much to provide for future bad debts that they may have trouble collecting, etc., etc. There's all sorts of guesses and assignments that managers need to make in the accounts to, I guess, protect the business for future risk. But it does give them a fair bit of leeway to affect the earnings of the company based on those kinds of things. The operating cash flow is very high up in the accounting statements, and there's not much in the way of provisioning that can be done to affect it. So it's basically the revenue that comes in less the cost of collecting it. And that's a very simple metric and a way to value the business. So I'll grant people that it's a quick and dirty. And if you want to do your own analysis on how much CapEx a company like this might need for the future and make your own assessments on that, then go ahead. But I found operating cash flow to be a really good metric as one of the determinants of value that we use. So this company scores very, very well on that basis. It also, interestingly enough, scores well on the price to free cash flow, and I'm using Stockopedia to give me that number. We don't put it through our spreadsheet, but the Stockopedia ratio for free cash flow was 0.9. So it's pretty much the same as PropCap. So it's very low as well in this particular case anyway. We use Stockopedia to give us the health ratings for these companies because the Q and QAV is we're trying to find quality stocks to buy at value, because basically value stocks fall into two camps. One is they're cheap because they're going through their day in the shadow rather than their day in the sun, and they'll come good again. And the other one is because they're bombed out and they're going backwards, and eventually they'll probably go broke. So quality is a focus for us in investing, and we use Stockopedia to give us a ranking for that. And Stockopedia ranked Zim as 82 out of 100 for quality, which is not their highest, but it's in the top 2 deciles, so it's pretty good. They use a system called the F-score for financial health, and people can go and look that up on their website. But the F-score is fairly well known in accounting circles or analytical circles, and it's basically a checklist which checks off to see the company's making money, that the company can pay its debts, all that kind of thing, and it gives it a score. And the F-score for this company for financial health is 8 out of 9. So the F-score for Zim is very high. So I've got some comfort that it's not going to go broke in the near term at least. And so therefore I can focus on the value, knowing that it's a quality company and it's doing well from that kind of perspective. We don't use return on equity as a metric. I don't use it, but Zim is high at 44%. So I'll point that out for any listeners who are interested in ROE. And again, one of the reasons why I don't use ROE, even though it's oftentimes a key metric for analysts of stocks, is because my experience is that when something becomes focused on by the broking community or the fund management community, it gets gamed by the unscrupulous operators who run companies who try and make their ROE look higher than what it probably was intended to look like. And there are some ways to do that, for example, by taking on debt, which reduces the equity in the company. And so a fairly ordinary company will start to look good from an ROE perspective because they've used up all their equity and extra borrowings, and they put themselves on shaky financial footing just to maximize their ROE, as an example. Stockopedia have a couple of ways of ranking companies, and they do provide an overall ranking as well. So for anyone who's not familiar with Stockopedia, go and have a look. They're what's called a factor service. So they've done a lot of research over the years on various factors as ways to invest, and one of them is value investing, one of them is momentum investing, one of them is quality investing. So they kind of put all those three together, give a company a ranking out of 100 for all the companies that they've looked at, and then combine that ranking for an overall ranking. And it's a pretty good service, and we need a service like that to be able to download data from the market to run through our checklist, and we use some of their tools as well. For this company, Stockopedia ranked Zim as 99 out of 100 overall, so it's very high on their list, but that's largely driven by their value ranking for this company. So they're also seeing value in it like we are. I'm using a stock price of $20.22 at the time of recording for my analysis. And a couple of things that we look at is, can I buy this company for book value? And the book value is $42.39, which means I can buy it for a lot less than book value. So not only can I buy it in an attractive cash flow basis, I can buy it for less than the equity in the company and also the net tangible assets. One thing that we track is whether the companies that we look at have qualified audits, because we rely on the auditors to tell us if the quality of these companies can be suspect for any way. We don't get too many qualified audits, possibly not enough, but we don't have one in this case. Forecast earnings per share growth is 25%, which is very high. We put that over the PE ratio, and so we find that growth over PE, as you said before from Peter Lynch, is a good way to look at whether the company's growing and whether we want to pay for that growth. And the hurdle we look at is growth over PE of more than 1.5. And this company is growing at 25%. PE ratio is at just over 5, so it's well above the 1.5. One thing we look at is yield, and this company has a low yield of 1.1%, which is fine, but too low for us to score. One of the reasons I focus on yield and look for a high yield is because it's a sign that management have some confidence in the future earnings of the company, because management is very low, boards are very low to cut dividend payments. It's often seen as being a last resort in tough times, and a cut in the dividend is a red flag for whether we invest in a company or not. So if a company has a high dividend yield, it means management are quite confident of being able to maintain that, which is a vote of confidence in the company. Additionally, from time to time, I have borrowed against my house to invest in my stock portfolio, and having companies with a high yield allows me to service the mortgage on that debt. And so that was another reason for ranking companies based on yield. So this company doesn't score on our checklist for yield. It's too low, but just that's by way of as explaining why we do score things for yield. Anyway, for this company, we give this company a total QAV score of 0.98, which is very, very high on our buy list. Puts it number 2 on the buy list at the moment. So yeah, that's ZIM. Have a look at it, and it's recently come onto our buy list. I don't own it. Cam doesn't own it, I'm pretty sure. We'll always declare if we own stocks when we talk about them. I don't own any US stocks at the moment, so it's probably going to be an easy thing for me to maintain. But by all means, don't take my word for it. Go and have a look at it yourself.
Yeah, we hold it in the QAV US portfolio, but I should specify that's just a example portfolio. It's a dummy portfolio. It's not real cash. It's just we created these dummy portfolios in Australia and the US as a transparent experiment to show how the system works in real time over a period of time. People can see the full list of trades, what we've bought, when we bought it, what we sold, when we sold it, and can see how the numbers work over time. So it's not magic, it's not theory. We're actually applying the system in a transparent way, and people can see how it's panned out over time. And as we move forward with the US show, I'll provide full trading history updates that'll be available to our listeners. They'll be able to look at it on the website and see everything that we've bought and sold in the US portfolio to see if the numbers that we say it's returned actually make sense. And you'll be able to go back and see the full history of that. So it's not opaque. The process is very transparent. Yeah. Well, thank you for that, Tony. And I noticed that when you did that pulled pork on Zim, you really didn't get into the ins and outs of the future of the shipping industry or the future of, Israeli shipping, or you didn't really talk about the prognostications of shipping at all.
I didn't, no, because I don't know about shipping at all. As Paul Keating used to say, an Australian Federal Treasurer, it's a beautiful set of numbers. That's what our checklist is aimed at finding, whether it's in that industry or any other industry. The they all have to apply the same accounting standards and produce the same accounting reports for us to look at.
Yeah. Well, thank you, Tony. And I guess that's where we'll wrap it up. That was a longer episode than I anticipated for our first episode in the US, but that's QAV US episode 1. As we always say at the end of our episodes, have a good week and happy share market.
Yeah. We also say happy ASX usually, so we'll say happy NYSE instead.
And NASDAQ.
And NASDAQ, yeah. Although I doubt if we'll ever keep buying on the NASDAQ, but we'll see. I could be wrong.
See.
I'm terrible at predicting, so we'll see.
Yeah, we don't predict.